I want to welcome back Michael Pento of Pento Portfolio Strategies and pentoport.com. Welcome, Michael.
Thanks for having me back on, Elliot.
No problem. So, the world needs an active, data-driven strategy like yours more than ever, in my opinion, because the internet has so much information. You could read a fear-mongering story about Evergrande or the fact that there's 500,000 containers still to come into the port of LA and think insane stagflation and credit risk. Or you could read the corporate media cheerleading the Federal Reserve and say everything's fine, but your strategy is actually data-driven. So what is your model saying right now?
Well, the model still says that we're heading for a period of disinflation later in the fourth quarter, when we're going to enter the fourth quarter, now. So here we are. So we're in the fourth quarter. Listen, here's the thing. You have to understand why the inflation came all of a sudden all over the globe. It really isn't a mystery to me, but it's a mystery to most people. It's not that they printed money and it finally caught up to them. It's the fact that they paid trillions upon trillions of dollars, in the case of the United States, $6 trillion for people to stay home because of the pandemic. They stayed home because of the pandemic, and they had all of their purchasing power plus more than they had prior to the pandemic. But because people stayed home and they didn't produce goods and services, there was massive supply chain constraints. So you had very few goods and services available for purchase, but a massive amount of demand. Consumption demand was there. And that's why you have this inflation. But that is slowly going away, happening now. In fact, after Labor Day, we lost most of the pandemic unemployment relief that was out there. And then a big chunk of it also goes away in January with the expiration of the child income tax credit. So people will slowly get back to work, I hope, I believe, but that's going to free up the supply chain and just replace some of the income that they had before we had, massive helicopters drop trillions of dollars upon the United States and indeed across the world. So I'm not fooled by this. I mean, today's not a very good day for me. Yesterday was a much better day than the market. So, the market goes up and down. Sometimes my strategy works. Some days it does. Some days it doesn't. But it's not what happens today or this week. It's over the course of the duration of time. Are you right or are you wrong? Is the economy decelerating or accelerating? Is inflation going to accelerate? By the way, we were on the right side of accelerating inflation for many, many quarters. It's just that if you want to go long, natural gas and oil now, well, you might be right for a couple of weeks or maybe a month, maybe. But you're in a lot of danger because these things are going to absolutely crater. I believe absolutely crater either the first or second quarter of next year. To be very clear, I'm not saying that we are deflating now. I'm saying that the rate of change, so the second derivative, so if inflation is running at 14 and it goes to 10, or if it goes from 10 to 7, that is a disinflationary environment. So the rate of change is falling, even though inflation is accelerating. Okay, that's all I'm saying. That is it. So I don't gamble with my money. I look at the facts. I look at the second derivative of growth and inflation, and I invest accordingly. And I'll stick with that.
No, absolutely. And it's worked. I mean, right? Because you can read through the noise. Because again, a lot of people just read one article about how, there could be a supply chain disruption and think it's 1970s style stagflation. But your model actually will say whether it's inflation, deflation, growth, slow growth.
Let me just add to you, if it's runaway stagflation, we do have stagflation now. I'm not going to deny it. It's stagflation now, but where are you headed? Where is the market going to be heading to? Not what happened before or what's happening at this very second. If it was runaway stagflation, why is the dollar up on the year? You would think the dollar would be weakening. The dollar is up over 3% on the year. And a lot of these commodities, put up a chart of Freeport-McMoRan. Now, I mean, this stock peaked in the summer of this year, and it's absolutely plunged. Why? If you're headed for an era of accelerating global growth on top of accelerating inflation, you would think Freeport-McMoRan and Southern Copper, U.S. Steel would be soaring. I mean, put up a chart of the XMI. which is the industrial sector. These stocks are not doing well. They're down significantly from the spring and summer of this year. So there's a lot of things that aren't confirming to me. I mean, the dollar's not getting killed. Break-even spreads aren't going through the roof. In fact, they're pretty much treading water. So they're kind of, if anything, this is telling me this is a consolidation period, a transition period from stagflation slowly to disinflation in Q4. And then I think we're headed for a period of deflation, primarily caused by collapsing asset prices in the second quarter of 2022.
So it seems like we're almost back to status quo, right? Where the Federal Reserve kind of plays like the market like a puppet and says, okay, well, we're going to taper, and the market believes it and is scared and gets, starts crashing things like we're seeing now. And then they're going to reverse that with dovishness. It could cause this real bull market in risk assets. Do you see kind of more upside for risk assets like stocks?
No, I don't. I think we're going to have a meltdown in the stock market come the second quarter of 2022. You have to think about where we're starting from. So the total market cap of GDP, maybe you don't follow that. I'm not speaking to you personally, but maybe Wall Street doesn't care or they don't acknowledge it. I follow that as the most accurate measure of the valuation of equities. Because equity shouldn't become too far disassociated with the economy. I mean, I think we can agree on that. Well, that was 140% at the peak of the NASDAQ bubble. So let's think about March of 2000, 140% of GDP, total market cap of equity. So we had a NASDAQ bubble, and that bubble burst. And you saw between March of 2000 and the end of 2002, that the NASDAQ lost 85% of its value, a little over 83. And the S&P, which wasn't really in so much of a bubble back then, but still lost 50% of its value. Well, today we're at 200% of GDP. So that's your starting point. So let's just take, that's your starting point. So we have by 60 percentage points higher than we were at the incredible, unbelievable, dangerous level in March of 2000. Now here, let's look at the scenario, what we have going forward in 2022. We have what I believe will be higher taxes because Biden's going to get some portion of his infrastructure package done through reconciliation. He's going to probably raise the debt ceiling, I think. The Democrats control the House, they control the Senate, and they control the White House. I don't think that they're going to be the position that is untenable, that they can watch the entire U.S. economy go down the toilet because the full faith and credit of the Treasury goes down the toilet on their watch. I just, that's my base case scenario. But there'll be, posturing last minute, midnight deal. But they'll get everything done through reconciliation. But it's coming with higher taxes. And it's not going to be 3.5 trillion infrastructure. It'll be more like something like 1.5 trillion because you have Sinema and Manchin in the Senate will say, no, we're not going to go for 3 trillion, 3.5 trillion. It's 1.5 trillion. So you're going to have a very small infrastructure package, which is spread out over 10 years, but you will get higher taxes. So you have the record high asset prices sitting on top of higher taxes. You will have a higher rate of inflation. You have a higher rate of inflation that we've had today than we have in the last 40 years. That rate of inflation should come down a little bit, as I said, disinflation, but it's still higher than the 1 or 2%, average that they had for the last, dozen or so years. So higher taxes, higher interest rates, and higher inflation. Did I mention higher interest rates? Interest rates are rising. Now, I know the level is low, but it's the rate of change that's all that's important. So you have higher interest rates, higher taxes, higher inflation. China is suffering from the most gargantuan asset bubble in history in their country, which is the housing market. That's starting to unwind. You see their manufacturing factory sector is in decline now. So China, which is the second largest economy on the planet Earth, is disabled. It's going offline. It's going to be very little growth. I mean, they'll report some kind of BS growth, but really they're in recession. So China is in recession. They're not going to help the rest of the world. Europe, the biggest customer for Europe manufactured goods is China. So if China's demand goes down, the demand goes down. Europe and China are the second biggest economies on the planet. So you have higher taxes, higher interest rates, higher inflation. China is offline. And all this is going to come in the middle of a massive monetary cliff where the Fed has to stop printing $120 billion every month. And they're going to have to taper those assets precisely because they understand that they can no longer allow, home prices to go up 20% a year. They no longer feel comfortable selling $1.5 trillion of bonds into the Fed funds market to drain excess liquidity out of the repo market and the Fed funds market. The banks have so much money right now. They don't know what to do with it, so they're actually selling it back to the Fed just to earn, I think they earn a nickel. So you have that monetary. So the Fed is going to be tightening into the slowdown. And on top of that, you have the fiscal cliff, which we go from, $3.7 trillion deficit in 2020, $3.1 trillion deficit in 2021 to maybe a $1 trillion deficit. Now, you don't grow an economy by deficits. I understand that. But when you borrow from the Fed $3 trillion and hand it out to people and say, hey, go buy stuff, that's temporarily stimulating to the economy. I mean, the government, the formula for GDP is C plus G plus I plus or minus net exports. So the G, which was a huge part of like 30% of GDP, is going almost, it's plunging. So you have 1/4 of GDP, and you have the net exports too. I mean, who are we going to sell stuff to? I mean, China, Europe, they're going to be disabled economies too. So you have the biggest fiscal cliff in history, the biggest monetary cliff in history. You have higher taxes, higher interest rates, higher inflation, and a global slowdown. And the Fed is going to be ending QE into this. So no, I am not very exuberant about the stock market heading into this calamity, especially since we are in danger of losing somewhere between, anywhere between 50 and 80%. And I'm not sure the Fed is going to be able to solve the problem by saying, oh, we're going to start printing money again. Well, that's just going to send bond yields higher and wreck the stock market. So that's my answer. Long answer, sorry.
No, it's a great answer. And what I love about your strategy is that you have, your fingers on the pulse of it. So you're not saying, oh, go short stocks, go short the S&P 500 today, right? You're saying in a few months, which means that the market cap to GDP could get even higher in the next 3 months though, right? Like kind of a melt up top before that.
It absolutely could, Elliot. I have no shorts in the portfolio whatsoever. I did raise a lot of cash coming into September. I was like 35% cash by the end of August. I raised even more money in the past couple of weeks. There's no guarantee that October 18th comes and goes and they don't raise the debt ceiling. I mean, that's my base case scenario is they do, but what if they don't? It's just too dangerous. I mean, when the market is this expensive, you just have to be a little bit cautious. It doesn't hurt you. I mean, maybe you miss out on a couple of gains and maybe you still lose some money some days, but in the long run, you have all that capital, all that dry powder to deploy when things start to settle down. And, you have to be, for me, myopically focused on the credit markets. There's a lot of components in my model. I have a 20-point model in the inflation, deflation, and economic cycle model, 20 components to it. And a lot of them have to do with the high frequency daily moves in the credit markets. Think about junk bond spreads, break-even spreads, LIBOR spreads, BSBY spreads. I mean, it's arcane. I don't want to get into it. No time for that. But when the credit market right now is kind of hanging in there. So, I mean, I don't want to short the market, 2 months too early and get my head handed to me. But when the credit markets start to falter, and they always falter first, credit markets start to freeze, and then the stock market starts to go down. Sometimes they happen concurrently, but most often it's the credit markets give you some kind of pause. Then it's time to ride the four horsemen of the economic apocalypse, which is you have to have a lot of cash, short-term treasuries, you have to be long the dollar. Sorry. It is the case that when the world gets scared, people rush into the dollar. It's just a reversal of a carry trade. It's mechanical. It's not my opinion. It happens. And you have to short the market. I'll be shorting the stock market. I'll be shorting the junk bond market. I'll be shorting the Russell 2000. So that's what I plan on doing. And it's a good plan because, investing and getting rich and making a lot of money is often about preserving your capital. Many times it's just about not losing money. And that says a lot. That goes a long way to help you out.
I mean, I can see kind of this last ditch melt up happening and then like maybe the prime short, but of course your model will be right there. And of course, for all the gold bugs out there, you are saying that there will be a sustained higher inflation next year, which is scary, right? From a very high, much higher level than where it is now. And you may think it's transitory based on supply disruptions now, but going forward, it could get really scary, right?
Well, what I'm saying is that you don't know, I don't know exactly what the response from Washington, D.C. will be. I mean, I can take a very educated guess. They're going to come with a massive amount of stimulus. You'll see the Treasury probably issue, $5, $6, $7 trillion in helicopter money, which will be all monetized by the Federal Reserve, which will lead to runaway stagflation. Might not help the stock market. I have to see what it does. I have to model what it does to bond yields, but it all depends on their response. And when does that response happen? My predicate is that this reaction that I just had, this massive fiscal and monetary stimulus, which is going to come ex post in arrears after the stock market's down 30 to 50%. I mean, it'll go down, it can go no bid, and in 3 weeks be down 35%, maybe even less. You have circuit breakers now. You can't lose more than, I think, 7% in a day or something like that. But I mean, it's going to be in a response to frozen money markets. When the money markets freeze, they have to do something. I mean, of course they'll do something. But when that happens, do you want to lose 30% of your money? I don't really have any desire to do that. And like I said, you look at what happened in 2000 and in 2008 and in 2018, 19, 2020, all crises were met with lowering interest rates and going into QE. And they could do so because there was no real inflation the way they measure it. I mean, there's massive inflation in asset prices. They don't care about that. But the way they measure it, they go, hey, there's no inflation. The consumer price index is quiescent. Let's just go and, we'll just cut interest rates and print up a bunch of money and everything will be fine. If they have to do that, Elliot, in 2022, they will fool nobody. That no one will believe that, hey, you know what? We don't have a problem here. I think the Fed will be able to end QE and drain its balance sheet and raise interest rates when this next crisis is over. Everybody's going to know that you have a problem with inflation and you cannot ever be able to fight it. So that might erode completely the confidence in our currency and in our sovereign bond market. And if that's the case, then you could see a massive spike in yields from here, which would destroy the stock market regardless of what the Fed does. Anybody talking about that? I do.
Yeah. Right. That's huge. Absolutely. You absolutely nailed it 5 months ago. You're saying, I think you're in dividend stocks, and very exciting to get another update from you. So where can people go to learn more and stay on top of this active strategy?
So it's pentoport.com. You can sign up for the midweek reality check every Wednesday. I put out a little treatise on what my opinions are. It's $49.99 a year for that. You can become a client if you have around $100,000 to invest. We take new clients here, and they'll put you directly in the IDEX strategy, which is, very cognizant of protecting principal. It tries to make money during asset bubbles when they are inflating. But most importantly, it tries to protect and profit from declines. And there's going to be another, I'm not a Cassandra. They happened. They happened in 1987. They happened in 2000. Then they happened in 2008. And then they happened in 2018 and 2019, 2020. And they're coming more frequently and with greater intensity. And I think the next one's going to be very dramatic for precisely the reason that I mentioned, that the Fed has jumped the shark. The Fed and Treasury have jumped the shark on inflation. Okay? We can no longer ignore the fact that we have created inflation to the tune of, close to double digits, higher than it ever was prior to 1981. So outside that era of the 70s, when we had 15% CPI. But if you measured CPI the way you used to measure it, it is 14%. But no one can deny that we have inflation now. I mean, every company that reports earnings is saying, hey, we got an inflation issue here. So they have inflation. Even though the rate of change is going to slow, it's still there. But that is going to come into deflation, I believe, as a result of the implosion of asset prices, which is set to happen in the first half of 2020. So come to my website. You'll get my thoughts. You get my money management. And you can always email me, mpento@pentoport.com. And the number for the office is 732-772-9500.
Brilliant. Thank you so much. We'll be looking forward to see what happens in the dystopian scenario next year in 2022.
All right. Look forward to it, Elliot.
Thank you very much. This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.